The psychology of investing, how to master your emotions in the market. When it comes to investing, the biggest battle isn't with the stock market. It's with your own mind. Greed, fear, overconfidence, and impatience are the emotions that quietly ruin portfolios. To succeed long-term, you must learn to control your psychology as much as your strategy. 1. The fear of losing money, loss aversion. Studies show that people feel the pain of losing twice as strongly as the joy of winning. That's why beginners often panic sell at the first dip. Reality check. Losses are temporary, but selling at the bottom makes them permanent. Pushpin example. During the 2008 financial crisis, many sold out of fear. Those who held on or kept buying saw massive growth in the following decade. White heavy checkmark mindset shift. Instead of fearing losses, see them as a discount opportunity. 2. The greed trap, chasing quick riches. Greed makes investors chase hot stocks or put all their money into the latest hype, crypto, meme stocks, etc. This usually ends in regret. Pushpin example. Bitcoin buyers at its $60,000 peak watched it crash to under $20,000. Many sold at the bottom, only to see it climb again later. White heavy checkmark mindset shift. Don't try to get rich overnight. Focus on steady compounding. That's how wealth is really built. 3. Herd mentality, following the crowd. When everyone is buying, you feel you should buy. When everyone is selling, you feel you should sell. But following the crowd often means you're too late. Pushpin example. Meme stocks like GameStop and AMC. Many who followed the crowd got stuck at the top. White heavy checkmark mindset shift. If you're making an investing decision because everyone else is doing it, pause. Do your own research first. 4. Overconfidence bias. A little success makes beginners think they've cracked code. Overconfidence leads to risky bets, too much leverage, or lack of diversification. Pushpin example. An investor doubles money on Tesla stock, then thinks they can repeat it with every stock. Soon after, they lose half their portfolio. White heavy checkmark mindset shift. Always stay humble. Even experts are wrong often. Stick to strategy, not luck. 5. Impatience and short-term thinking. Many beginners want results now. If their portfolio doesn't skyrocket in 6 months, they jump ship. But wealth building takes decades, not days. Pushpin example. Warren Buffett made 99% of his wealth after the age of 50 because compounding needs time. White heavy checkmark mindset shift. Ask yourself, will I care about this dip 10 years from now? If the answer is no, stay the course. 6. Emotional roller coaster market cycles. The market naturally goes through booms and crashes. Beginners let emotions guide them. Excitement during booms, fear during crashes. Pros stay calm and follow their plan. White heavy checkmark mindset shift. Expect a roller coaster and ride it with discipline. Key takeaway. Investing is 20% numbers and 80% psychology. If you can control fear during dips, resist greed during booms, ignore the crowd, and stay patient long term, you'll not only build wealth, but peace of mind. High voltage hook for your video. The biggest enemy of your investments isn't the stock market, it's your emotions. Today, I'll show you how to master your psychology and invest like the pros. Passive versus active investing. Which strategy is right for you? When it comes to investing, there's an age-old debate, passive versus active investing. Each strategy has its strengths, risks, and followers. Knowing which one suits you depends on your financial goals, time commitment, and risk tolerance. 1. Passive investing. The set it and forget it approach. Passive investing is like planting a tree and letting it grow. Deciduous tree, you don't stand over it every day, but with time, it provides shade and fruit. White heavy checkmark typically involves index funds or ETFs that track market performance. White heavy checkmark lower costs, minimal fees, and management. White heavy checkmark less stress, since you're not chasing short-term trends. White heavy checkmark historically. Many passive investors have matched or even beaten actively managed portfolios over the long term. Example story. Sarah, a young professional, started investing in the S&P 500 index fund every month. She didn't worry about the ups and downs of the market. Years later, Her steady contributions compounded into a large nest egg, all without her needing to check stock prices daily. 2. Active investing, the hands-on approach. Active investing is like running a business. You're constantly monitoring, making decisions, and adapting to opportunities. White heavy checkmark involves picking individual stocks, bonds, or sectors based on analysis. White heavy checkmark opportunity to outperform the market if you're skilled and disciplined. White heavy checkmark can take advantage of short-term opportunities or undervalued assets. Warning: higher fees, trading costs, research, and management. Warning: requires more time, effort, and emotional discipline. Example story. Mike, a finance enthusiast, actively invests in tech companies. He researches trends, follows quarterly earnings, and times his buys and sells. In good years, Mike beats the market, but in bad years, his portfolio takes heavy hits because of poor timing. 3. Key differences between passive and active. Feature: passive investing, ZZZ, active investing, high voltage. Time commitment, minimal, high. Costs and fees, low, high. Risk level, moderate, market risk. Higher, market plus human error. Returns, market average, can outperform or underperform. Best for long-term, busy investors, hands-on, analytical investors. 4. Which strategy is right for you? Ask yourself, do I want to spend time researching investments? Am I comfortable with market fluctuations without reacting emotionally? Do I want predictable, long-term growth, or am I chasing higher, but riskier, returns? Backhand index pointing right if you want simplicity, lower stress, and steady growth. Passive is your best bet. Backhand index pointing right if you enjoy research, analysis, and higher risk for potential higher reward. Active could be for you. Backhand index pointing right, many smart investors use a hybrid approach, putting most of their money in passive funds while actively experimenting with a smaller portion. Takeaway: there's no one-size-fits-all strategy. Your choice should align with your personality, financial goals, and lifestyle. The key is consistency. Whether you're passive or active, staying disciplined will pay off in the long run. Sparkle's motivational closing. Think of investing like climbing a mountain. Some people take the steady trail, passive investing, walking step by step until they reach the peak. Others choose the steeper, riskier climb, active investing, hoping to reach the top faster. Both paths lead upward, but the right choice depends on your strength, patience, and style. At the end of the day, it's not about who gets there first. It's about reaching the summit safely and enjoying the view. Sunrise over mountains. All right, let's talk about one of the biggest questions every beginner investor faces. Should I go with passive investing or active investing? Passive investing is like taking a steady trail up a mountain. You're not rushing. You're not stressing over every little bump. You just set up your investments, usually in something like index funds or ETFs, and let time do the heavy lifting. It's simple, low cost, and historically very effective. On the other hand, active investing is like choosing the steep, adventurous climb. You're picking individual stocks, timing the market, and try to outperform everyone else. Sure, the rewards can be higher, but so are the risks. It requires more time, research, and sometimes nerves of steel. So, which one is right for you? Honestly, it depends on your personality, your goals, and how much time you're willing to spend. If you want hands-off growth while you focus on your career or family, passive might be your best friend. But if you love analyzing markets, enjoy a challenge, and don't mind risk, active investing could fit your style. At the end of the day, the most important thing is to start. Both strategies lead you up the mountain, and the real win is reaching the top: financial freedom. Understanding risk and reward in investing. When it comes to investing, one golden rule always stands. The higher the potential reward, the higher the risk involved. But the key is learning how to balance both so you don't jeopardize your financial future. 1. What is risk in investing? Risk simply means the possibility of losing money or not getting the return you expected. For example, stocks can soar but also crash, while bonds are steadier but offer smaller returns. 2. Types of investment risks. Market risk. Prices of assets can go up or down. Inflation risk. The money you earn may lose value over time. Liquidity risk. Some investments are harder to sell quickly without losing value. 3. Reward, the other side of the coin. Rewards are the gains you get for taking risks. Higher stock returns, rental income from real estate, or compound growth over time. 4. Risk tolerance. Everyone has a different comfort level with risk. Some investors can handle market ups and downs without stress, while others prefer safer, more stable investments. The secret is knowing your personal tolerance and investing accordingly. 5. Balance. A smart investor spreads investments across different risk levels. This way, you're not putting all your eggs in one basket, and you still position yourself for steady growth. Lightbulb think of investing like driving a car. You can go fast, high risk, high reward, or slow, low risk, low reward. The real goal is to choose the speed that gets you safely to your destination. Financial independence. Watch out for the next chapter.